this with us on the webinar today is going to be all three of the managing partners with our group called PassiveInvesting.com. And we have with us here Danny Randazzo, if you'll say hi there. We also have Brandon Abbott on the line with us. And of course, myself, Dan Handford. For those of you who don't know who we are the managing partners with a group called PassiveInvesting.com. You can find the website here. I'm just going to type into the chat box here so you guys all have that link if you wanted to go take a look at our group. You can also go to meet the team, and each one of our partners are listed here alongside of our team members. So you can click on each one of those videos and actually find a video talking a little bit more about ourselves. That way we don't spend too much time today on the webinar talking about ourselves. So you can certainly do that. If you're interested in joining us on one of our acquisitions here in the future, you can go to our website, PassiveInvesting.com. You click on that little join Passive Investing Club. There's a form there that you'll fill out, and I'll jump on a phone call with you and discuss your investment goals one-on-one to see if we're a right fit for you. The last thing I wanted to mention is about our premium program. If you go to the webinar today and you enjoyed this webinar, we would love to give you a free trial today at this webinar. On this webinar, you're going to join the Multifamily Investor Nation Premium membership. So go to mfinpremium.com to find out more information about it. I'm going to type it in here into the chat box, that link for you, mfinpremium.com. So you can go over there, take a look at it, and see what it entails. And you do get a free 2-week free trial. And one of the things we are also going to do is in that 2-week free trial, we'll extend it till April 10th, which is right now it's only about an extra day on your free trial. But because of the COVID-19, we decided to extend it to April 10th for you there. So go there now, check it out. And then today, we're going to be covering the multifamily investing response and impact of COVID-19. And we're going to be talking about a lot of different things. And today, instead of going kind of line by line on this platform like I normally do, we're going to have a discussion with you, kind of a roundtable discussion between the three managing partners. That's why I invited them on, because I thought it would be better and more beneficial for you to be able to hear from each one of our team members, to be able to hear a little bit about what we're doing and what you should be doing and considering when it comes to the multifamily investing side of things. So let's kind of also tell you that as we're going throughout the conversation today, we want you to submit questions to us. So that's why I want you to be familiar with that chat box so you can submit some questions. We will be monitoring those throughout as we're having this kind of dialogue and discussion. And so I think one of the things that we should kind of go over first is really about, what should you as a multifamily investor, if you have some active properties, what should you be considering doing right now, given the pandemic that is out there right now? And I know, Danny, you on our team primarily focus, not primarily, but one of your kind of roles that you kind of oversee in our group is the property management. So you're not doing property management but from an asset management perspective, really kind of monitoring that thing on our assets. And so I'd love to kind of hear from you a little bit about, what are some things that need to be considered when it comes to taking action on your properties to, mitigate the risk and to protect the health of, the residents, but even the actual the on-site staff that are on the properties as well.
Yeah. It's difficult to say exactly what you can do to be prepared. I'll talk a little bit about some of the things that, we've done or are continuing to do and or trying to do. I think the difficult part is that, things are changing so rapidly. I learned something at 11 a.m. Eastern time today, and it's changed by 12 o'clock today. So I feel like the information is changing not only day by day, but potentially hour by hour. And so, one of the things that we have done in terms of staff at a property is just taking the measures to close down any amenity space. A lot of this information has kind of been presented and shared through the National Apartment Association, NAA, and NMHC, National Multifamily Housing Council. So there's some really good guidelines. If you're not familiar with those, check them out. If you are an owner operator, you should have your management company should be very in tune with what guidelines those two organizations are releasing regularly. And if you are an owner, operator, self-manager of a large multifamily property, think about closing those amenity spaces down if you have not already. Limiting in-person interaction. The great thing about the multifamily and kind of real estate industry over the last decade has been the advances in technology. And so when you have those advances in technology, we're able to, in some instances, really service everything remotely, or really with extremely reduced physical interactions when you think about it in terms of social or physical distancing. So a resident can submit an emergency request or make a phone call or a regular maintenance item online or via phone, and then you can dispatch a technician out to go in with protective gloves and masks and service that emergency. We've tried to limit. I lost my train of thought there.
Sorry about that, Danny.
My
I typed
chat
something.
box.
I was trying to respond to somebody. I wrote the word "write" down, and he got that in his head. So
I meant limit the physical interaction. So when you send a maintenance person to do a repair, ideally maybe that resident leaves during that time frame, or they isolate the repair and just fix it, and then the resident can go back and clean it, or the technician can wipe things down if they touched it. So it's just kind of doing those standard procedures that everyone has heard from the news. In that regard, from a on-site safety perspective, and again, a resident safety perspective, you don't want to have a ton of people walking about the property or using the amenities. So with that, what other measures have we done from a on-site staffing perspective? Well, whether you have a huge multifamily portfolio, one single property, or maybe a collection of single family homes, it's really important to go back, if you haven't, and revisit some of the employer demographic information for your residents, just to get a pulse on what type of employment they have. Is their income potentially at risk with this shutdown? And just being educated, being prepared, right? We don't know what everyone's situation is going to be come kind of this time next week, right? April 1st, rents are due, and they're late by the 5th. And so, it's thinking through those scenarios, thinking through what we can do to help those people as well. So, some sort of payment plan, late fees, reducing any sort of stress. At the end of the day, we're all humans. We are all in this together. And, we've also talked about just extending residents wherever their current rent is at least for a month-to-month perspective until we get through it and kind of get on to the other side of this and get to some sort of stabilized piece. So getting prepared, thinking through it, looking at that resident demographic information, having plans in place, knowing what sort of relief may be available is important as well. For your properties and for your specific areas. Like some counties have programs, some charity organizations have been set up and are available. Again, knowing the process for your particular area to get unemployment. I'm not sure if that differs state by state or county by county, but I know there's been a lot of difficulty with people filing online just from an overwhelming strain on the internet, I'm just going to call it. So knowing those processes and procedures, that's going to be really important. It's going to help you kind of identify those risks, and then thinking through, from an operations perspective now, how do we kind of think through potential impacts to income? How do we think through our expenses? Right? So you still want to pay your on-site team, you still want to pay employees, but are there other areas where we can save and reduce? Something to evaluate and look at. I think every every vendor or even lender is willing to work with people. It's about being proactive. Maybe we can get into this later on if there's time, but the agencies, Fannie and Freddie, since they're government-backed agencies at this point, they've released some forbearance information, which it's basically, to summarize in my own words, it's basically like a payment plan for the borrower, where you could pause your payments for up to 90 days, and then you basically repay that amount that you've kind of deferred over the next 12 months into the future, in addition to your current mortgage balance. And so there's a lot of people coming together. Really, at this point, I don't think there should be a major nervous feeling about kind of falling apart or being foreclosed on or being evicted. It should really just be everyone coming together to kind of get through it. And I've seen it even just locally, in South Carolina. The energy companies are working with people to not shut off service for non-payment. But again, you need to be proactive. And that's the biggest part to it, is it's not just, either a resident, they can't just not pay. Just like we as owners or operators, we just can't not pay. You need to be proactive in having those conversations to be prepared and just tell people what's going on. And, everyone's pretty understanding. I always think back to something that my grandma always said growing up is, if the story was published of what you did on the front page of the newspaper, how would you feel about that, and being able to see your friends and family after that story broke? And I think, a lot of people would be embarrassed if they just didn't pay and weren't proactive about it. But hey, if I came to you, I said, we're having trouble, we need to do something, how can we work together through this? I think people would be very kind of proud of doing that. And so I think there's a lot of opportunities out there. Again, from an operations perspective, one thing, actually, I'll give two quick things and I'm going to kind of wrap up, Dan. So I've been rambling for a few, but two really good things from an operation perspective, regardless of the size of the portfolio that you have. Number one, I would highly encourage you all to cease any unnecessary expense spending. So bring that to zero. For example, this time of the year in some southeastern communities, it's getting to be pool season opening time. And so that means usually prep to inspect or do any sort of seasonal pool cleanup. I would say do not spend a single penny on doing that right now, because our amenity spaces are still probably going to be closed. And so residents are going to understand if the pool's not open when everybody gets back to work and back to normal, if you will. So cease any unnecessary expense spending. I would also include in that any sort of non-life safety critical repairs. So if you were looking to put like a new sign at your property, or, maybe paint some fire hydrants or paint some signs around the asset, I would again say kind of cease doing any non-life safety to bring your expenses down. I would make sure that the teams are really walking all of the properties to shut down any unnecessary lights, expenses. Some of these things can be really, really small, but at the end of the day, all of the dollars saved is very helpful in this type of situation. And the second thing I will say, regardless of the type of portfolio that you have, you need to set up an accounting general ledger, a GL code specific to COVID-19 to track any sort of expense loss. So this could be bad debt from a rental. It could be a concession if you are giving someone kind of comped rent. It could be expenses incurred as a result of COVID-19, such as extra extra cleaning supplies, extra cleaning from a contractor, extra gloves or protective equipment. Anything and everything that could be related to COVID-19 needs to have its own GL code, so you can track every single thing. It's probably likely that the National Apartment Association, along with NMHC, along with the state and federal governments, is going to have some sort of tax benefit or tax break for owners who have been affected by either loss of income or increased expenses. And so maybe that will kind of be like a year one bonus write-off. Again, no idea. Information is changing hour by hour, but I would diligently track that income and expense impact as a result of COVID-19. And with that, I'm going to pause. I have not been looking at my chat box, but Dan, catch me up to speed here if I had any questions.
I've been monitoring it, and I'd like to kind of shift a little bit to Brandon here, because when we're talking about property management and on-site stuff and doing a lot of things for the, amenity spaces and things like that, and, withholding, any type of non-essential expenses, and even keeping track of it, like you mentioned, Danny, and the GL code to, make sure that whether you are trying to get some additional tax benefits or whatever in the future, or maybe you're in the process right now of selling your asset or buying an asset, you want to know what kind of impact you have on it. Let's shift to you, Brandon, a little bit, and have you kind of discuss a little bit about the impact on renovations, because obviously renovations are being done right now, and renovations should the renovations be considered to be stopped right now, or should we, go ahead and just continue as business as usual, or what's the kind of the general consensus that you're seeing right now?
Yeah, sure. And, as Danny mentioned, you want to really look at what is essential and what is non-essential. Now, from one perspective, the renovations are an essential part of your business plan, right? So if you're not achieving rent premiums because of renovations, then you're not achieving the budget that you need. However, you're already going to have some bad debt and some delinquencies as it stands right now from COVID-19. That's what we're all assuming. So that being said, if you have units that are already in the process of construction, it makes sense to complete those, right? Because it does no good for them to be sitting halfway done. In other words, you're stopping essential spending by not completing them, but then you have down units that you cannot possibly get revenue on. So you want anything that's in process, complete it. And that's very important to understand. That is an essential expense, completion of a project. The next one is the kind of,
One thing I would say too, depending on everyone's scenario, property type, location, let's say, for instance, you had a property next to a major restaurant chain and all of your residents were restaurant workers, right? Maybe you try to get some of those units back online to keep people occupied. I think you still want to move forward to get your units working and completing the renovations, but you could always consider dialing the scope down to get a unit available faster. But that's just me talking from a dollar kind of occupancy perspective. And I know it's important, it would really impact your next type of renovation work or construction work, but that's an option to think about just for people, depending on the scenario, the type of asset, the location, and yada, yada, yada. But at a high level, I agree. I think you continue with getting vacant, non-rentable units in a rentable condition and or a renovated condition, so you can get people in there.
Correct. And what I mean in process is it's one that you already started your original scope of work on. And it doesn't make sense to, in the middle of that process, deviate from that, because in the end, you're going to want to do that again, and to have to go back and maybe undo something, the cost goes up. But you may have some units that were getting ready to be renovated that were already vacant. You may make the decision to not just to kind of turn those. In other words, just put some paint, clean the carpets or replace the carpet, and not do the full scope of work. But ones that are in the middle, like you've already demoed it and you've already ordered cabinets and granite's on the way, just get those done, spend that money on that. But if it's just vacant and it's maybe on the schedule for next week to start demo, it makes sense to look at whether you should continue with the full scope, like Danny was saying, and maybe just scale it back and get that rentable without having to do the full turn. And then on the next renewal, start that renovation on that particular unit. And then, when you're doing renovations, you're looking ahead. You're always looking at your renewals that are coming up the next month and when they're going to come available for the renovation team. And so you're always tracking that. So as people are coming up for renewals, you're trying to increase the rents, and you want to focus on retention at this point in time. So when you had people that maybe had already put in notice to vacate because they didn't want a renovated unit and they were going to move on due to the unprecedented circumstances, it makes sense to go back to them and say, hey, look, we understand the times. We're here to help. We understand the human component. We were getting, doing a market rate increase just because it was lagging, but we understand it's hard to move right now. So, if you want to stay on maybe a month to month or whatever your particular situation may be, to focus on retention and try to keep as many of those people that were up for renewal in place at this moment in time. And in that sense, halt the renovation process instead of let's just keep going, as normal and let's just turn people out and get them renovated, because I think you would end up with a large vacancy number at the end of the day, because we are going to see that lag catch up to us in renewals or in new movements, I guess, especially when traffic is reduced coming into the office, because we're doing virtual tours and we're trying to limit the amount of traffic into the office. So that does have an effect on people that come in and lease new units. And if you're in a metropolitan area or city that has a shelter in place, it's definitely affecting your traffic and whether they can move or not. So again, just focusing on retention. So just to kind of reiterate or recap, anything that's in process in the normal scope, you've already got stuff ordered, get that completed, get it online. And hopefully you won't have to offer any concessions to get that unit leased, but at least get it in a rentable condition, because no matter what, it can't be rented halfway done with construction. Number two, if one has not been started in construction but is vacant already, look at maybe reducing the scope of work and getting it to the point where you can get it rentable without spending the whole scope of work at this time. That would be considered a non-essential expenditure. And then the ones that are coming up for renovation but are still occupied, focus on trying to retain those tenants in place as much as possible. Now, you're not going to be able to do that all the time, and that's just the nature of where we're at right now. So that's kind of my viewpoint from the renovation standpoint.
So from a financial perspective, when we're doing the underwriting on a project, before maybe somebody might have been underwriting to 12 to 15 months to stabilize during renovations, should there be some additional kind of extensions on that right now and underwriting a deal that they may be looking at right now to maybe extend that past that original time frame? Because we don't really know right now how much of an impact this is going to have and how long it's going to last.
Yeah, stabilization is definitely affected right now. If you're looking at a deal right now to underwrite to purchase, you have to extend that. And like you said, nobody knows what that period is. It is an assumption at this point in time. We can look at how much we've been delayed right now and then look into the future as to, let's say, I'm not gonna make a prediction, but we've heard talk of like Easter, okay? So is that the period that you need to extend your delinquency, or is there going to be a lag where the economy has to catch up, and so your delinquencies are going to be doubled by that time from when we started this kind of social distancing to Easter, and then double that? I think, from our group, and I'll let Danny maybe expand on that, as we always try to underwrite on the conservative side. So if we're already looking at, a month of kind of standstill, and we're still looking at going possibly to Easter, we need to at least go past that in your stabilization expansion in your underwriting, and not cut that short.
Yeah, and before you answer that, Danny, I would like to also talk about beforehand about two different things that CoStar just came out with, one of their reports. Every day right now, we're getting reports from CoStar because we're a subscriber to their software. And there's two things that really stuck out to my mind. And this is, again, these are national trends. These aren't local specific. And every deal that you look at, you have to look at the data in that particular market and the sub-market within that market where that asset is located. But across the board, the national rent growth since this happened in the month, especially in the month of March, has seen a negative 0.3% decrease in rent growth, where it was actually still on an upward swing. It actually is now starting to see a downward swing because of the stagnation in the market. And a lot of this is data that they're getting off of assets that are using the daily pricing models, which every day they're at their actual pricing of their rents are changing based on demand in the market and vacancies. And so they're starting to see this start to drop down. Again, coming up in April and into May, we're going to see a little bit more, price movement. And that's mainly from a rent growth perspective. So I think we're definitely going to see some effect on the rent growth across the board nationally. Again, every submarket's going to be a little bit different with that caveat there. And the second thing I want to bring up is about vacancy rates. And again, this is not dissecting it from A class, B class, C class, or anything like that. This is really an overall national trend that we're looking at here. But nationally, the vacancy rate is already at 6.5%. So there's an increase in vacancy rate across the board right now. And CoStar mentioned that even some of these markets will see up to 9% over the next couple of months and even more. This is a historical high that they've actually had that they have right now on record. It's the highest they've ever seen. And the reason why that 9% number is there is because, and again, that's like the worst case scenario that they're projecting. They like to do like a best case and a worst case scenario, right? And in that worst case scenario, it brings up to 9% across the board. And the reason why is because the new construction units right now that are coming online, that new supply, whether it be in a new supply of affordable housing or new supply of Class A, that new supply absorption rate is going to be affecting the absorption of the decrease in the vacancies that are coming online with the existing assets. And so when you have both of those that are commanding demand at the same time, it causes that vacancy rate to start to drop. So with all that said, I'll turn it back over to you, Dan, to kind of follow up and tag the question I posed to Brandon about renovations and kind of what should in your underwriting should somebody be considering when they're trying to kind of mitigate the damage of what's happened right now.
The one thing I will say is I read the same information from that report that came out this morning, right? The thing that I concluded and really took away from that is the comment from the person who put the report out there was that the data set is too small to use the numbers for anything valuable. It's really a tiny data set, and that they're trying to annualize over the next 12 months. And he said it is, I'll put it in my words, what I heard from it, it's worthless to use. So again, national averages, it's great. Obviously, some major metros are going to take a huge significant hit, and some other communities may get through pretty clean. So I think it's important to know what's going on in your specific market, which I would classify as kind of at a county level, but then specific to your microeconomy right around your asset. That being said, to answer the question, yeah, I think you need to, if you're looking at a deal today, you need to kind of take this unprecedented time into consideration. And so, I think you have to come together with everyone involved in the process. If you're working with an owner and a broker and somebody else, there's options, there's solutions. I think you just need to think through and like what can be done or can't be done realistically. What's the worst case scenario? What's the best case scenario? And how do we fall kind of somewhere in the middle to that? And I think that's the best I can kind of provide at the moment. I don't have any data or facts to support Any information at this time, I think it's very subjective as things are moving again, hour by hour. You'll probably hear me say that 2 or 3 more times today, but it's just the nature of the beast that we're in at the moment. But I think I'm optimistic that, again, we're all humans. We are all on Earth until Elon gets us to Mars, right? So we're still going to deal with this together, and we need to. Brandon, what do you think about that comment?
Very interesting.
Well, and one of the things I'll also mention, and that was, also discussed in that same article by CoStar, and we don't have a link to share with you guys on that because it's actually behind a paywall, I guess, if you will. You have to be a subscriber of CoStar to have that article. But what that article also mentioned is that these are short-term effects, right? These are effects that are going to last, 2 or 3 months in the short term, potentially up to maybe 4 to 6 months, but they're short term. Long term, multifamily is the place that you want to be investing your money because, yes, pandemics, do cause some short term, hiccups, if you will, and your business plan and your underwriting, but pandemics also create a couple other things, right? They create 3 things. They create marriages, they create divorces, and they create more babies. I like to call them Corona babies at this time, right? I wrote an article and posted it everywhere about Corona babies. People aren't going out of their houses, so they're making more babies right now, right? So when those 3 things are created, that creates increased demand. So demand for multifamily is not going away, right? The demand for multifamily is just going to continue to go up and up and up like it has been because we're not contracting when it comes to the population. The population is continuing to expand. So long term, the health of multifamily is still extremely strong.
Correct. And as far as demand for multifamily, it hasn't gone away at this moment in time. It's just that the traffic is sheltered in place or practicing social distancing. So they still want an apartment, and they still want that, what we're offering. The clients still need that product that we have. It's just that this has created a short-term restriction on travel and freedom of movement, and that's all this
well,
is. We know that will continue.
I mean, the other important thing to know too, it's for the general public to be safe and sheltered in place. Essential services, and it kind of varies state by state, county by county, city by city. Essential services are still kind of out and about. And, I would think if someone is in need of finding a new home, right? Maybe they're moving out of their old place, or maybe they just got a new job and they started today. They may be out looking for a short-term rental or, an apartment to live in for the next 12 months. So, it's about being safe. It's about following the local guidelines, but also, people still need to live, but just keep your social distance or physical distance from others.
So one of the topics that I want to get into is from a lending perspective and acquisition side of things. And, we want to talk about where are rates going? Where are they right now? Again, Daniel would probably say it changes hour by hour, which it does right now. But I want to get into that. But before we do, I wanted to touch also on 2 different things. I wanted to touch on, investor distributions right now, and some things that you should be considering on your assets when it comes to investor distributions. And then also maybe if you're looking to put a deal under contract right now, or maybe you have a deal under contract right now, what can you expect from a capital raising efforts perspective as well? So, because that's kind of where my role is in the group, I'll kind of address both of these things before I turn it over to Danny to kind of talk a little bit more about acquisitions and the lending side of things. So from a investor distribution standpoint, as a whole, every project that you have is going to be handled just a little bit differently based on the amount of reserves that you have in place, which hopefully you are conservative with your underwriting and you have ample reserves. Our group likes to have enough reserves that if the property went all the way down to 0% occupancy, we could continue to pay the expenses on that asset for 4 to 6 months, which going down to 0% is a really, I would say a true black swan event if that actually occurred, right? But we want to make sure that we have that in place. And if we don't have to dip into those reserves, we really don't want to have to do that, right? but it's there just in case. And so you have to, every asset that you have to look at that particular asset, see where your operating reserves are, see where your capital account is, and make the determination, is it wise right now for us to go ahead and withhold distributions? Maybe it's just short term, 1 month, 2 month, or 1 quarter, 2 quarters, depending on where that property is and renovations and cash flows. And again, every asset's going to be a little bit different because one asset might only have a drop in vacancy by, a couple percentage points, but another asset might have like, 10 or 15%. And so right now, nobody really knows because March collections pretty much came in as usual, right? For the most part. And then coming up next week in April is really when we're going to start to see the true sign of the effects of the COVID-19, when the rents are now due. And if you have an asset that has a lot of people in travel and hospitality and leisure and restaurant industry, you might start to see a lot of those people having an inability to be able to pay. And that's going to be a situation where you're going to probably have to make that hard decision to withhold distributions. Now, our group does monthly distributions, so we're making these decisions on a monthly basis. And that's one of the reasons why I only choose to invest with people that, have those monthly distributions, because I want to make sure that they're having to make the decision on distributions on a monthly basis and not just retrospectively at the end of the quarter. So we are making these decisions on a monthly basis, and we haven't made any final decisions on any of our assets yet. So far, the collections have come in March. April collections will come in next month, and we'll make that determination at that time. But so far, since we've done demographic studies on our assets, we don't really feel like there's going to be a major impact on our assets. But again, I'm speculating. We don't really know for sure. But that's why you have to, in your assets, really monitor them very closely and to make sure that you're putting certain things into place and that you're also taking advantage of the forbearance that Fannie and Freddie have taken out and made available to us. And even for those of you who have a non-agency loan, whether it be CMBS or Lifeco or a bridge lender, or maybe even a local bank, be reaching out to those lenders proactively and seeing what kind of opportunities that they are creating for you, because chances are they understand this is an unprecedented time. These are not normal circumstances, and a lot of your contracts, even with the lenders, might even have some force majeure type of clause in them that causes you to be able to have some additional forbearance or whatever when it comes to the actual loans that you have gotten on these types of assets. So that's what I wanted to mention to you about the investor distributions. The second piece is about your capital raising efforts. So I will say that right now there's a lot of investors that are uncertain, right? They're just not really sure what's going to happen. They maybe be preserving capital because they're just not sure. Or, I've even seen some investors that, they're not really uncertain, but they really need to preserve their cash right now because maybe they didn't lose their job. But I'm seeing a lot of even medical professionals and dentists and attorneys and, accountants that are not necessarily losing their job, but being forced to not see patients and being forced to not create revenue that they normally would have had. And they're basically saying, hey, we need to hold off right now because I'm not making any more income for the next 2 or 3 months, and I don't really know where my cash flow is going to lay out. So I need to maybe hold off. So you are going to likely see some sort of effect, some sort of decrease in the amount that you're going to have. But if you have enough lead time and enough leeway on that particular asset and that contract that you have, you're likely going to have things are going to likely turn around in the next 30, 60, 90 days that you will be able to still be able to raise the funds that you need for your particular asset. So just know going into it that this is not a normal circumstance. These are not normal times. And so if you had trouble raising funds for a deal in the past, you're going to probably have even more trouble this time. But if in the past you didn't have any trouble at all and you've gotten more investors into your database since then chances are you probably will be okay. But you have to, again, know what your investor base can bring to you when it comes to these different projects, and know that there might be a little bit of a drop in that. So when you're looking at that next asset, you need to be careful. One of the other things I'll mention before I turn it over to you, Danny, is about, people are talking right now all over the place about finding really good, solid, discounted deals because the market is now going to just tank, right? And people are going to be, foreclosed on their properties, and that may be the case in some situations, but again, I don't think the default rate is going to be that high, even in this particular situation. And the ones that are going to default are going to be the ones that are in those lower end properties, those lower end B's and C class properties that their underwriting was a little bit too tight and they have a drop in occupancy and they are just not going to be able to pay their expenses. And those are the assets where those owners are going to get frustrated. Typically, probably a smaller mom and pop property. They're going to get frustrated, put it on the market just to get rid of it and preserve their cash, right? But when you have a really good, solid property that has great cash flows, it has great historical financials, and there are, it's in a great market, great sub-market that's actually surrounded by a lot of blue chip corporations, you're going to be protected. I don't feel like those types of assets right now are really at risk right now of doing that. So I'll turn it over to you, Danny, so you can kind of talk a little bit about the lending side of things and what the lenders are looking for right now. It's, I say lenders, there's really only two right now that are lending. It's Fannie Mae and Freddie Mac. And then also talking about from the acquisition side about what rates are doing and what is actually the movement in rates. What are they causing different operators to have to consider and do right now for people who maybe had a deal under contract beforehand, or maybe they're considering putting one under contract now?
Yeah. Brandon, did you have something you want to jump in with real quick?
Well, I was going to comment on the discounted market rates that Dan was mentioning about, foreclosures, with the forbearance options in place. I don't think that's going to be as severe as some people are talking about, because they have that option in place. And yeah, we understand that some people did not underwrite in a conservative manner and maybe didn't have enough reserves, but they do have this forbearance option. So I think that's going to be much, much less. I mean, the fundamentals of the economy are sound. This is a restriction of movement of clientele, and that is all. It's not a fundamental flaw.
I mean, again, what I would say is important is, number one, you should be trying to pay all your bills, your expenses, your debt service, right? Your mortgage. And, everything is changing hour by hour. I'll sneak that one in one more time. Maybe I've got two more left in me. We've got just a few more minutes here, but I can probably get two more in. Things are changing, like I said, hour by hour. I'll just do one more at the end probably. But, the forbearance is not just a given thing. You need to apply for it. You need to work with your lenders. You need to understand what's going on. And so the best thing that I would say, going back to, again, regardless of how big your portfolio is, you need to understand your resident employer demographics to understand your true risk. Are most people nurses and teachers and government employees who are still getting paid like clockwork with their W-2 paycheck? Because those are going to be your people who are going to pay, right? And if they're not paying, then shame on them, because they should be. And I think you as a management or owner operator, again, need to have very good rules or plans in place for how to evaluate what really requires relief and things of that nature. But as far as what's going on in the kind of lending space, with this uncertainty, I think there's a lot of lenders who are publicly traded companies, and that can be an issue when your stock price plummets or swings drastically up and down. And there's quite a few people who have kind of hit the pause button and saying, I don't see the light at the end of the tunnel yet. I'm just going to hit pause until we get the all clear. And, I think that's a reasonable thing for people to do. Does that mean that there's opportunities out there today? Sure. I think that they do exist. I think there's also, like you said, there's liquidity in the marketplace through the agency lenders. I have talked to a couple of local attorneys, and refis and new home purchases are still going on. People are still closing deals as they were before. Multifamily deals are still getting closed. Other acquisitions now, maybe a hotel purchase or an office building purchase like a WeWork type of deal. Maybe those are on hold because of the uncertainty. And I think, again, you take it day by day and hour by hour. That'll be my last time saying that, but I did
No, it won't.
fit it in nicely. So with that, I think, you need to be smart about things as lenders have kind of slowed and pulled back, right? It's given the agencies, Fannie and Freddie, a lot of volume of business, where I think one of the questions came in of where are interest rates at? Well, interest rates are going up at this time compared to where they were at the beginning of this month. Now, I think interest rates are probably to where they were 4 to 6 months ago. So it's not a huge movement, but depending on the timing of when you were evaluating deals and debt and loans and income and expenses and all of that, it may have an impact on your particular situation. So what I would suggest is working very, very closely with your lender to understand where are the rates at today, when can we rate lock, what's the timeline looking like? Are things still on time, or is it taking more time than usual because of the amount of volume that's in for the business?
Can you explain a little bit? Because I know there's probably some people listening right now that are wondering, well, the Federal Reserve has gone down, the 10-year Treasury is down. Why are rates going up?
Yeah, rates are just going up because number one, they can because there's less competition in the marketplace. Typically, you have a lot of private lenders out there doing deals, both very small, your short-term fix and flip private lenders. A lot of them have hit pause. You have your kind of middle market banks that have kind of pulled back on the marketplace. You have a lot of lenders that will do some shorter term deals on their balance sheet, and they are kind of hitting pause to minimize the amount of debt that is on their balance sheet. So I think people are wanting to see how markets perform. Again, can you get a deal done today? Absolutely. Is the interest rate going to be a little bit higher than it was 3 weeks ago? Yes, absolutely. But there's dollars available, there's liquidity available. Now, the question is, not all deals are created equal. Like I said, I would bet I'd bet somebody $1 that they would not close a hotel deal today. I just don't think that's reasonable given the occupancy in hotels has been, I'll call it near zero. But maybe there's hotels in New York that have been swamped with extra people and government employees living there through this crisis. I have no idea, but the hotel industry seems scary. So that being said, I think you can get deals done. I think it's a short-term impact. Hopefully we get to some light at the end of the tunnel and have some positive news. But again, keep an eye on things day by day, month by month, and just know your
Hour
people.
by hour.
Thank you. I didn't say it, but you did. We'll take that as a win. But know your people and communicate with them. This is a time of everyone is coming together. So that means, attorneys, insurance people, your residents, of course, your management teams, your on-site teams, your maintenance repair people. Know what's going on with them. And I'm just a firm believer that there's a solution out there. So how do we work together to get there? I don't think we're at this point where, everybody throw the towel in and just go home. I think, there's plenty of solutions available. It's just about how do we work together to get through it.
So, the bottom line here is from the lender's perspective, pretty much all the lending has dried up when it comes to anything other than the agency loans right now, especially in the multifamily space. There's still a few smaller banks or local banks that'll do some of the lending. Typically, there's going to be more recourse lending. They might have an increase in loan to value, but really kind of Fannie Mae and Freddie Mac are the main agency lenders that are lending right now, or the only agency lenders, but they're the main lenders that are lending right now because demand has increased for refis as well as, new acquisitions right now, because they're the only, kind of game in town. Rates are actually, going up. Rates are going up, which is caused because the demand is going up. And this also affects a couple other things when it comes to your underwriting. So when your rates go up, your proceeds go down. So you have less money that's they're going to lend to you. So your loan to value will go down. And it's mainly because of the DSCR. So you're constrained by that DSCR, and it's going to cause you to have to raise more equity. It's going to decrease your returns and also cause the cap rates to expand. So yes, we're going to see some expansion in cap rates, but again, I think it's still short term. I think there's still a lot of demand for multifamily. It's going to, on the other end of this, it's going to continue to go down like we've seen over the last several years. And so I think overall, you're going to see a total cessation of acquisition activity right now, because a lot of people are just kind of, in a holding pattern over the next couple of months to kind of see what's going down. And because of that decrease in demand, that's also where you can capitalize on getting some better rates, because some people are still wanting to, are forced right now to sell because of, maybe they're trying to get out because they're coming to the end of their loan period or whatever, and they need to be able to get out. So because of the decreased demand, you'll have less competition when you're trying to acquire. And so our group is still active. We're still actively looking at deals, still underwriting projects. The tours have been a little bit light because, you can't get out when you have a shelter in place in certain markets. But we are still actively underwriting them. We've submitted a best and final last week. And so we're still, things are changing, right? They're constantly changing, and, we're having to go back and kind of make some modifications, but we're still actively acquiring right now, even in the current environment. I think it's a good idea to be able to be in that position as well. And we're going to get some good pricing on some of these assets as well. And so any other, final kind of parting thoughts from either one of you before we kind of wrap things up? I know we have a lot of questions that came in. We answered a lot of these questions that came in kind of with the rest of the content that we provided today. In 2 weeks from now, we're going to be doing another one of these webinars around COVID-19, and we'll have a lot more data. We'll have a lot of more information to be able to kind of share with you and talk with you about. And so make sure you check your emails and to be aware of the next webinar that we're going to do on an update for COVID-19. But anything from you, Danny, kind of final parting thoughts?
My parting thought would just be to work together. I think there's opportunities that still exist. So keep your head up, keep working on it, and have people help you along the way.
Brandon?
Yeah, exactly. I think it's just a matter of keeping your head, making smart business decisions based on the information you have at hand. You can't speculate. This whole COVID-19 is proof that you cannot underwrite every circumstance. So you need to have reserves in place for the unknown, and this is truly an unknown. But when those unknowns occur, keep your head, use the levers that you have in front of you, pull the levers that you have, and keep moving on. The world will continue to turn, and as Danny said, we're all still here on Earth until Elon gets us to Mars. I think it's what
that was the quote. Yep.
So Jason here just typed in I think the final thought of the hour, which is going to be keep up to date hour by hour, right? And things are changing.
Well, and the other thing too is I'll just say it's okay to take a break. Sometimes there is just information overload, and don't feel bad if you need to step away after this webinar and take the rest of the afternoon off if you have the ability to do that, and wake up tomorrow refreshed. I think there's so many things that change, and it's just a roller coaster of emotions. So it's okay to take a break. Go exercise, meditate in your home, your shelter in place, make a beautiful meal, read a book, play backgammon, play a board game, do something different, and just step away from the information overload at times.
So I have one question that somebody asked in here about me talking a little bit too fast. If I can review one more time what I was talking about as far as rates and cap rates and demand. So I'll go through that one more time. and we'll have that ended up here. And I want to again have a special thank you to Danny and Brandy. That could be useful this time of year, huh? No, I mean this time. Danny and Brandon for joining us here, even with such short notice. When I started seeing how many people were registering, I was like, I know we need to get Brandon and Danny on here to help out a little bit. So, well, I'll recap this real quick for you, Frank. Basically, because there's only two lenders with the agency side of things, Fannie and Freddie, the other lenders have kind of dried up. It's causing the interest rates to go up because the actual demand for that type of debt is going up as well. And these agency lenders only have a certain amount of money that they can lend every year. And so go ahead, Danny.
Yeah. So earlier this week, the Fed announced that they would do a $700 billion buyback of mortgage-backed securities, which is what Fannie and Freddie sell off. They since revised to, I think earlier this week, to an unlimited buyback. So to that point, they do typically have caps. I don't know what the impact of that statement from the Fed means yet. I think it's too early to tell, but we'll watch it hour by hour and see what it truly means to each asset class. So typically, yes, there are caps of how much they lend per bucket. But the Fed did commit to buying back an unlimited dollar amount. So it was last week, 700 billion. This week, I think it's unlimited. So don't quote me on that, but let's see what develops.
And just to kind of finish that off, to wrap things up here, I know we have less than a minute left. Because of that increase in interest rates, that increase in interest rate is going to cause you to have decrease in proceeds, because when you increase the interest rate, it actually affects the DSCR and causes that DSCR to go down. And so in order to get you back to that 1.25, which is typically what you'll see. It depends on the market. Sometimes it's more. Very rarely it's a little bit less than that. But it causes decrease in proceeds, which causes you have to raise more equity. And then also because of that, equity is also always costs more than debt. And so your returns will start to go down, and it causes the cap rates to go up. So with all that said, stay tuned for 2 weeks from now. We'll have another update on the COVID-19 impact and response. And I will try my best to get Brandy and Danny back on the line as well. Yeah, Brandon and Danny back on the line as well in 2 weeks. So thank you so much. I really appreciate it, gentlemen.
Take care. Thank you.